In this video, guys, we're going to look at 4 broad methods for buying stocks and finding those winners. Stay tuned. Hey traders, warm welcome to you. So 4 broad different methods for buying stocks. These are not very scientific in terms of not drilling down into a specific strategy, but a broad approach that some investors use each of these to start from, and then they execute their filtering strategy to find the stocks they believe are going to perform well or best for them. Okay, so let's look. I've split into 4 quarters here. Let's go with the first one. So the first one is buying low. What does that mean? That basically means when you've got, if I can draw on here, that basically means a stock price that's doing that. It's been rallying down, or should I say drifting down. There's nothing rallying about it. Is it trending down into the downside, and you're buying as the price moves to maybe a 52-week low. Okay, so the advantage of that, by the way, these little pluses here are possibly the advantages, and the minuses are the disadvantages. Again, comments in the comment section below as always. Pros and cons of this, agree, disagree, all good, stick it in and I'll read it. So buying low. A first thing, positive thing, potentially, is it's undervalued. If the price has been moving lower, there isn't a potential argument that this stock is undervalued and it's gone too far, and you might find a bargain there. The other thing could be it's just a short-term struggle. Okay, I mean short term as in a year, because it's a 52-week low, if you're using that as an example. And then ultimately the company's fine, but it's just going through a bit of a rough patch. Maybe management's changing. Maybe they brought out a product that flopped and it's kind of hurt earnings a little bit, but they're solid. They've been around a long time. They've got a good brand, a good balance sheet, whatever it may be. That could be a short-term opportunity for you. Another positive could be there's greater room for profit. Of course, you're buying at lows, it goes back to highs, you've got all that juice and more. So theoretically, you could say all it's got to do is to go back to where it was, and I've made a decent amount of money, and if we carry on with the rally, I'm going to make a lot more money. So that could be something that goes in your mind. Negatives for this strategy is that don't ignore the fact the company could just be in trouble, right? If it's at 52-week lows, it could be losing money, could have hit a rough patch. Similarly here, it could be losing market share, it could be doing all right, but the fact is other investors saying, these other companies are making inroads, they're taking chunks of wealth from this company, and even though this company's still making profit, it's just getting squeezed and squeezed and squeezed, and ultimately, unless they do something drastically different, this thing could go even lower. So that's buying low. Okay, let's have a look at go to buying high now. So buying high, flip side, let's say we're looking at 52-week highs. As an example, that would be buying high. Positive could be they're doing something right. In the day, if it's at 52-week highs, you would guess if the momentum's behind it and investors are buying it, which they are because it's at highs, they've got to be doing something right. Yeah, they should be producing profit. Everyone should be happy with it. The other thing is trend is your friend. If you're buying an uptrend, just the flip side of this, then why not continue buying it? The trend is your friend until the bend at the end is the actual phrase. But if there's an uptrend to it, why should it stop immediately? Maybe it'll stop eventually, but the momentum should keep it going. The downside of that is that there's no more room to grow. If you think of some of the bigger companies, I can think back on a few years ago, like Tesco, for example, in the UK, doing so well, making so much money, but they just couldn't expand anymore. To the point they were trying to expand, and they started making mistakes, and then they weren't looking at competitors, and so there's that argument. It's like, well, they've come so far. Why am I buying so late in the growth, and so late in the earnings stage? The earnings cycles has been so good and so good. Surely they're not going to be so good anymore. They're not going to keep improving. Maybe I'm buying a little bit too high. And then it's pullbacks likely to. From a technical perspective, of course, the chance of it pulling back from a 52-week high are going to be reasonable. Yeah, if it's pushed up, hasn't pulled back, it could pull back and still be a great stock with great, great earnings and everything's not changed, but people just backed off a little bit. You could get a 5-10% pullback on that, and it's nothing in the scheme of things. But if you're buying that, you've got to sit through that. It's not so great. All right, let's look at 2 others, guys. The other one is buying pullbacks. So rather than buying at highs, we're going to buy at pullbacks, not buying at lows or highs. We're buying at that sort of middle ground. It's been up, but it's pulled back. Positive of that is that it's just a temporary loss of momentum. You could say, hey, this is a good stock. It's running strong. It's got good earnings. Everything's good around it, but it's just lost momentum for whatever reason. I'm buying an X% pullback on it. It gives you a short-term discount, and it means the stock's in favor as well. So short-term discount, in other words, it's the same stock with the same earnings and everything's the same, but it's just worth less because it's just out of favor short-term, but it's in favor long-term. That's why we're in an uptrend. It's just whatever it may be, some profit taking, a little bit less buying, anything like that. Negatives on that though, it could be a trend change. Could be if it's pulled back significantly or a bit more than you think. It could just be that, hey, it's time for a few years of stagnation, regardless of what the balance sheet or the earnings are saying. Okay, and supply demand could be changing. So pretty similar to that. In other words, that again, the company could still be fine and doing well, and we haven't really talked about the fact that there could be something in the company that hasn't yet come out and people are sensing this, but regardless of that, it could just be supply demand changing. No one wants to add in more to their portfolio. There's no more inflow of money coming in causing that price to rally. The other one, which is an unusual one, which I have seen some people do, is just ignore price completely. They say, you know what, all that matters is the balance sheet and the earnings. Balance sheet and the earnings is all that matters. All I want to look at is how much money they're making, whether they're continually making money, whether they are expanding, whether they are cash rich, whether they've got low debt. I don't care about the price. I just want to see what's happening under the hood. Not influenced by value, so they're not saying, well, by doing that, they don't get a clouded judgment by thinking, oh, this is expensive or this is cheap. They're just analyzing it based on the data, and then the price comes in later into the decision-making process. The negatives are you miss the bigger picture, because the argument could be, well, you're trading price. You're not trading what you perceive to be the value, you're trading the price. If the price is significantly more than what you think it's valued, you're paying that for it still. Is that still a good buy? Maybe not, but then the argument is flipped that it is, because it's still growing and growing and everything's in the price anyway. And the other negative thing is a good story does not equal a high price. In the day, supply demand dictates the price. A good story, even a good balance sheet and a good company doesn't necessarily mean the price. If it's just out of favor and people don't want to buy it, they don't want to buy it. So you could be well out of sync with the price, but it's a way of potentially doing it that's different to all the others. So buying low, buying high, buying pullbacks, ignoring price, and just looking at the balance sheet and fundamentals. Anyway, guys, that's four broad methods for buying stocks. Any more you've got or anything you want to say, stick in the comment section below. I'll see you in the next one. Good trading. Goodbye.